Hello, and welcome everyone to today's Association for Manufacturing Excellence webinar titled Lean Accounting Principles, Practices, and Tools. I'm Jerry Strohmeyer, the Education and Training Program Coordinator for AME, and I will be your moderator. Today's presenter is Brian Maskell, the President of VMA, Inc. Brian has been working with companies for more than 25 years, and while he works with large and multinational companies worldwide, the majority of his time is with small and medium-sized companies striving to become truly lean organizations. Brian is an engineer and an accountant and is able to bring a unique perspective to the accounting, control, measurement, and decision-making issues of lean companies. He is a conference speaker, blogger, podcaster, and is the author of 8 books including Making the Numbers Count, Practical Lean Accounting, and the Lean Business Management System. Before we start, just a couple of housekeeping items. You will be in listen-only mode throughout the webinar. You will see that you are muted on your attendee panel on the right side of your screen. If you have questions during the webinar, please type them into your question area in the attendee panel and click on Submit. We'll review the questions at the end of today's presentation and answer as many as we can. When you log off today, please check your email inbox, and it will be an invitation and link to fill out a short webinar attendee survey. Please take a few minutes to complete the survey today, as your feedback is very important to us to improve future webinars. Brian has also graciously agreed to provide a PDF of today's presentation. We will be sending that along with a recorded link for a webinar replay to each of you next week. Now, I am pleased to introduce Brian Maskell, who will present Lean Accounting Principles, Practices, and Tools. Take it away, Brian.
Good. Thank you, Jerry. Well, good morning, good afternoon, wherever you are. And we're going to spend an hour looking at lean accounting. And I tried to put it in this, so we'll start with the principles, then we'll get into the practices, and then we'll end up then with some practical tools that you can actually use. So that's the plan as far as you can do it in an hour. And so let's make a start here. So principles, practices, and tools. The principles we're going to look at are, well, why do we do lean accounting at all? What are the lean principles and the lean economics, and how does that get put together into something that the accounting control and measurement systems can really address? And we're also going to look at, briefly, just one slide on what are the problems that come with the traditional accounting that many companies use. So why is lean accounting important? Well, lean, of course, is a powerhouse for making money. And what we're trying to do with lean accounting is to control the business, drive lean change, and then maximize sales, revenues, reduce costs, make more money. Now, the traditional accounting pushes back against that. And what we want to do with lean accounting is something that really focuses and drives lean forwards. So lean accounting is designed to motivate, monitor, and maximize the financial benefits, both short-term and long-term, of the lean improvement. So we've got to really understand what are the financial benefits as well as the operational benefits of lean. Lean accounting, too, is much less work. So it's kind of the lean itself, and the traditional accounting is the opposite of that. It really undermines what we're trying to do with lean, and I'll show you some examples of that. Now, let's get started then with some of the basics. You know, what are the principles of lean? Well, the very first thing is value to the customer, isn't it? Our focus of lean is to focus on what is the value to the customer that we provide, and why is that important? Well, because if you create great value for the customer, they're going to buy lots of your products or services or whatever it is your company does. The other side of this is that that's where you price products, isn't it? People are only going to pay for something they value. And so we've got to really focus on understanding how we create value for the customer. Number 2 is we make, manage, measure, and improve by value streams. Most traditional companies have lots of departments, and each department does some part of the business. In lean, though, we want to create value streams which have the whole flow of the organization, and we work based upon those value streams. The third principle then is flow and pull. You know, a lot of people think that lean is a lot to do with about eliminating waste and so on, and of course it is, isn't it? We do lots of elimination of waste, but why do we want to eliminate the waste? Well, we eliminate the waste so as to make everything flow better at the pull of the customer. So the ideal is that as soon as the customer pulls something, that the entire process flows without stopping, so that that's where single piece flow and things like that come into, isn't it? The customer orders one, that we provide one of that product or that service, and it flows without stopping. If you do batching and things like that, then you're going in the opposite direction, aren't you? You're making one and then it waits till you've done the 10 or the 100 or whatever it is that you're doing. So flow and pull is a big deal here. Number 4 then is all about the people, empowerment of the people or respect for the people. Lean is done by the people themselves who do the work. And now there are lots of different ways to do lean. Some is big breakthrough, isn't it? Some is continuous improvement. Some of these very small just do it sort of improvements that people do themselves, and then others are improvements that are driven based on target costing and understanding, how much can we sell this for, and therefore what needs to be the cost of the product. But all of this work, though, is done by the people who do the work within the company. Now, traditional companies tend to work the other way, where if they've got a problem, they will bring experts in, often people with colored belts and stuff like that, and they will be then analyzing the problem, and then the people will come and make the changes for you or to you. And in Lean, we need to do that sometimes, but mostly what we're after is improvement that's done by the people themselves, improving their own processes. And then the 5th principle is the pursuit of perfection. And that means we're going to keep doing this until we have no waste at all in our operation and everything flows just perfectly every time. How long is it going to take to do that? Well, probably not in our lifetime. So therefore, what does pursuit of perfection mean? It means that we're not implementing lean. It means we're changing the way we run our business so as to become a lean, continuous improvement organization. And if you turn that backwards as well, that means we don't have to do everything at once. Lean is done step by step, day by day, week by week, month by month, year by year. And there's never any end of improvement that we could make. So those are the principles around which lean works, and therefore these are the principles that we must fulfill within our lean accounting. Now let's look at the economics of lean. It's not about cost cutting, is it? It's about growth. It's amazing to me how people think of lean as we're going to implement lean and cut our costs. That's, of course, cutting cost is a good idea, but that's not what we're focused on. Lean is about growth of the business. Now, to do that, we've got to focus on customer value. And once we've understood customer value, then we can start eliminating waste, because waste is things that the customers don't value. And you have a lot more waste than you have value in all companies, including my own. Now, if we eliminate waste, does that cut costs? No, not really. I mean, sometimes it does, and of course it's good to cut costs. You might eliminate some waste, and now we've got material. We've improved our scrap and rework, so therefore we're going to spend less money on materials. That's an excellent thing to do. But by and large, when you eliminate waste, what you do is free up capacity. Free up people's capacity, free up machine capacity, free up space in our offices and our factories and other operations. And freeing up capacity is what mostly comes out of waste. So that means then, what do we do with the capacity? That's the best question. It's a good question to say, what did we save by doing this improvement? A better question is to say, what are we going to do with this capacity that we've freed up that's going to create more value for the customer and make tons of money? So we're going to use that capacity to design, make, and sell more products and services. And that's the way that we can then grow revenues and grow cash and create a lot more profitability. Let's take an example of that. Look, we got a value stream now that makes and sells 1,000 units, and we sell them for $200 a time. Here's a micro income statement here. So if we did that, we'd have revenues of $200,000 a month. Material cost here is $120,000, and we've got then production operations that cost another $60,000. So work that out, we're making a profit of $20,000, which is a 10% return. Now, if we can then use lean to free up 20% more capacity, what are we going to do? Well, we're going to sell 200 more. Let's assume there's demand in the market and your salespeople can do that. So we can sell 200 more. Now, what is the cost of those extra 200? Well, the answer is nothing, isn't it? Got to pay for the materials, but everything else is kind of comes free, because what we've done is freed up that capacity, and it doesn't cost us anything more to make those 200. So let's take a look at our mini income statement. Well, our revenue is going to go up by, 20%. Material cost will also go up by 20%, unless there's some kind of discounts on volume or something. But for this example, we'll say that it goes up by 20%. And our production costs are going to stay the same, but our profit now goes from 20,000 up to 36,000, 10% up to 15. So that's the kind of thing that we're looking for. But the real important point here is, look, our revenue has gone up by 20%. But what's happened to our profits and cash? That's increased by 80%. This is the economics of lean, is to eliminate waste, free up capacity, make and sell more products and services or whatever it is that you do that brings the money in. And this gives you massive improvement in cash. And we can then use that cash to grow the business. We can then use that cash to design more products and services, or we can acquire other companies that will fit well into our operation. That's the economics of lean. So we grow the business without growing costs. The lean accounting supports and motivates these lean economics. Now, as you'd expect, the traditional management accounting and standard costing actually opposes that. It pushes back against the lean strategy. Now, not because it's bad and wrong. Standard costing and traditional accounting, and nothing wrong with that at all. But it's designed for 1920s, 1950s, 1970s traditional manufacturing, and even you could look at this in terms of mass production. That's what it's designed for, but it isn't designed to work with lean operations. Also, it's very complicated, and it's got lots of weights itself, and it gives you information that's actively anti-lean. And we'll take a look at that when we get into the practices. So that's the lean economics. Now, how does lean accounting match to this? Well, these are just 6 topics that I think are some of the most important ones. If we look at the first one, timely information that everybody can understand and use. Now, I don't know about your companies. I'm sure there's lots of different ways that you work, but most companies produce financial information once a month and usually several days after the month. Now, that means you're only getting this 12 times a year, and what we really want to do is to have the financial information much more frequently. It might be every 2 weeks, it might be every week, it might be every day. We have customers that work in different ways on these kinds of things. But what we want to do is to have much more timely information, because that enables us to control the business, both financially and operationally, in a much better way. Now, tied in with this, we want to have financial information that anybody in the company can immediately understand and use. And I don't know about your company, but if you give a thought and you say, well, how many people in my company really understand the financial reports? And even non-financial reports. Like, for example, if you measure the productivity or of individual people or individual cells in your operation, what's that going to incent people to do? Well, they'll just make a whole lot of products, won't they? They've got to be efficient. They've got to spend all their time making products. Also, they'll probably make products in bigger batches. They might put batches together in a different way than the plan is, so that they can optimize the flow, things like that. And you're going to wind up then with having large inventories and probably products that are made in the wrong sequence, and so you may not have what you need when you need them. Also, the people will not have any time for doing lean improvement because we're pushing them all the time to be efficient. You see what I'm getting at? And I don't know if that makes sense to you, but people will do what they're measured on, but if they don't understand those things, then that's going to lead to bad ideas. What about overhead absorption? How many people in your company understand what overhead absorption is? And yet it drives really bad anti-lean behaviors. Again, not because it's bad or wrong, it's just a tool that is designed for something else. So we need operational information that everybody can understand. That enables us to control it better, and it also enables us to improve things better as well, both operationally and financially. Another one is we need better data that leads to better decisions. You know, if you're making decisions by saying, how will this affect a standard cost, for example, or we know what the standard cost is, we know what the margin is, and therefore we can make those decisions. You know, that's leading you in some really bad decisions. In lean accounting, we do have decisions in a much simpler and more thorough way. And better decisions give you better information. And we have decisions also is we want to move decisions to a much lower level in the organization. Now, this is tied in with the timely and simple information, but if we can have people at the lower level in the organization making decisions, then number one, the decisions will be better, but number two is you'll be freeing up the time of more senior people so that they can spend their time on things that are more strategic. So we want to have decisions that lead to higher revenues, lower costs, better profit, more cash flow. And lean accounting helps you do that. Let's look at the next one then, rigorous financial and operational controls. This is what we try to do in lean accounting, is really to create an operational system, both financial and operational, that's going to enable us to really control the business well. So financial information that's controlled more frequently, and financial information that is controlled not actually by the accountants, but by the managers and the people who are involved in doing the work. So that the value stream manager is responsible for the financial operations. And then we want operational information that immediately controls and enables us to resolve issues quickly and effectively. And again, this is the responsibility of the people doing the work. Now, why do we want to do this? Well, we want to do this because we want to build control deeply into the operation of the business. Because if you think about it, why do we have a management accounting system? Well, in most cases, one of the key elements of the management accounting system is to provide financial control to the business. But if we can bring better control into the operations themselves, then we don't really need those complicated management accounting systems because we've got the operation under control and we're building control into the operation rather than having a secondary system that's tracking and controlling the operation. We also want true financial and operational impact of lean to be understood. It's amazing to me when you go to companies and you say, well, what's the financial benefit that you're getting from lean? It's amazing how badly these are measured, in my opinion. Now, some companies really understand it and do it right, but it's very common for a company to say, well, we've done a KAIZEN event, and instead of it taking 10 minutes to make that product, it now takes only 8. And we make 1,000 a day, and we can multiply that out. We know what the labor cost is. We know what the overhead cost is. And so over a year, we're going to save, pick a number, $400,000 by that improvement. But actually, if you go back and you say, well, how many people are leaving the building as a result of this? Well, none. Do you still have the same equipment? Yes. Do you still have the same factory and office? Yes. Actually, a lot of these improvements, the financial benefit is rather small and nothing like taking to the way that it's worked out in the traditional way. So we've got to be able to measure, motivate, and maximize the benefits of the lean improvement. So we've got to be able to work out how to do it properly. We've got to be able to monitor it. And then we've got to pick the right projects that are going to give us the best financial gain. Now, of course, in lean, financials are important, but we've also got to be really focused on projects that may not give us financial gain, but will actually give greater value to the customer, which in turn later will turn into financial gain. So we've got to be able to really understand those things. Another thing is just simple and much less work. You know, if you do lean accounting, you have tons less transactions. Because if we can build control into the operation, then we can take away huge amounts of the transaction that are used by a lot of companies. We're talking about thousands, sometimes millions. We did work with a very large aerospace company, a company that makes aircraft. I won't tell you who they are, but they eliminated 3 trillion transactions, and that's just from one aircraft type that they make. You can't, I don't know, I can't imagine 3 trillion transactions. It's a huge thing. But that's what we want to do, is to really simplify the systems by creating real control within the operation. We don't need variances. We don't need absorption. We don't need complicated accounting systems. We don't need to measure efficiency. We don't need to do those things. We need processes and financials that are under control, and that takes away huge amounts of transactions. We've got about, I don't know, I haven't actually counted, maybe 12 customers now that actually have no controls at all in the factory. You know, they receive material and they ship product, but everything else is controlled visually and operationally. And these are not funny little companies. These are major corporations. And then the last one that's important, of course, is our accounting has to fully adhere to all of the regulations, generally accepted accounting principles, and the regulations that are required by the tax people and by the SEC and all of the regulatory operations. So we have lean accounting fully complying with that, but at the same time it's simple, low waste, and low cost. And it provides both management accounting and financial accounting. In the long run, lean accounting will eliminate or replace the way that you do accounting now. Now, I say in the long run because these are accounting systems, and we've got to be very prudent and cautious. So we take it step by step and make sure that we're in good shape before we actually start taking away a lot of these issues. So I hope these 6 things make sense to you. Timely information that everybody can understand. Better decisions, because the people understand it, we've got better information and more up to date. Better decisions lead to better profits. Rigorous financial and operational controls. Not something that's tracked a week or a month after the event and then put into complicated things like variances and overhead absorption, things like that, but something that is rigorous and clear-cut and happening right now. Then we've got to be able to measure, motivate, and maximize people's work on lean improvement so that we get the very best results. We've got to make it simple and much less work, and it's got to comply with all of the rules and regulations. So that's what we're trying to do with lean accounting. Now, if we look at the traditional accounting, I'm not going to beat this to death, but I've just kind of taken the same issues and shown how the traditional accounting actually pushes back against lean. And again, not because it's wrong, it's just designed for something else. So reports come too late, and the accounting methods are things people don't understand. We have measurements and financial reports that actively drive back against lean. You do a month-end push at your company, you know, we haven't made enough, we haven't sold enough staff, or we haven't absorbed enough overhead, so just on the 4th week of the month, you have to kind of shove out a lot of stuff. That's the kind of thing that comes from people who are looking at traditional accounting. Then we have decisions that are using standard costs, which almost always mislead you. Then we got complicated and wasteful systems that need to be tracked with these variances. We want to have something that's simple but very effective, and that's what we're trying to do in lean accounting. Now, of course, traditional stuff completely complies with all the rules. Now, there's lots of adjustments and complication that's done at the month-end close, but it complies with the rules. And then the last one is it's a significant workload. You know, what would you do if you were any accountants who are listening in here? You know, what would you do if you freed up 2 days a month, 2 days a week, so you could get all of your work done in 3 days, and now you've got 2 more days? What would you do? Now, I know some of you are saying you'd go play golf, but but what I'm thinking of is you'd then have time to do things that are much more strategic. And that's really what we want to do. We want to get the accounting done really well and effectively, but then we want to use the accountants and financial people's skills and knowledge to do strategic things that are going to drive the company forwards. So those are the principles of lean. Let's get into some of the practices here. Lean accounting drives lean forwards. We want to look at performance reporting, financial benefits, and box. And we're going to introduce you to the box score, which is how we use decision making. So why does lean accounting drive lean forwards? Well, we have measurements that empower people, measurements that control the process, and measurements that actively drive improvement. We have accounting, value stream accounting. We account at the value stream level. So we don't have a lot of detailed tracking of financials in cells or production steps and things like that. We look at the value stream level. It's simple in the sense that it's something everybody can understand, and it's summarized direct costing. So direct costing means what did we make, what did we spend? And it controls the revenues and the spending, and it gives reports that people can immediately understand. Decision making. We use the value stream measurements, the cost and the capacity, to really understand how does the value stream work? How are we measuring operationally? What's happening to the capacity? We're making better use of our people's time, our machine time. And then what are the costs? How much are we spending this week or this month? And that gives us real numbers. If we've got real numbers, then we can make better decisions. The financial benefit of lean, we can actually calculate the financial impact of lean improvement in terms of how much money is going to go in the bank. And that's something everybody understands, and it's real. And then the last one is simpler systems that eliminates millions of wasteful transactions. Now, if we contrast that with traditional accounting, you know, traditional measurements, what do they lead to? Thinking about overhead absorption and efficiency and things like that that I discussed a few minutes ago. That's going to give you large batches, high inventories, long lead times, and shortages. You know, it's a odd thing, isn't it? The higher your inventory, the more shortages you have. But that's really to do with batching, isn't it? And making things in, you know, you're making product day to day when the customer really wants to be, you know, those kinds of things. Financial reports, nobody understands them. Complicated accounting stuff, so how can you really use them? And it's very perplexing, I think, for people to find that kind of stuff. And what really happens is that only a few people in the company actually look at them. Standard costing leads to poor decision making, and I'll give you some examples of that in just a few minutes. It's expensive and wasteful, thousands, millions of transactions, lots of reports. You know, every transaction turns into a report, a reconciliation. This all turns into meetings and all kinds of stuff. But whereas we want to have much more of a stand-up meeting that's really focused on the real issues. And it's often, in many cases, it's about profits, not value. A lot of short-term stuff, a lot of make the month, a lot of absorbing overhead, a lot of focus on the stock price. I'm amazed, you know, because often when we're dealing with value to the customer, I ask people, you know, who is the customer? And it's amazing how many times I get told that the stockholders are a customer. Well, of course they're not a customer. They're an owner, aren't they? If you've got shares in a company, you're an owner of the company, maybe just a little tiny bit, but you're certainly not a customer. And in lean, we focus on the customer. Okay, let's get into some of the tools and methods here. Using a box score. Now, this is what a box score is. You can see it's got 3 pieces. At the top, we've got the performance measurements. So these are the handful of measurements that you've decided to use to be able to do operational control and improvement of your value stream. Now, what the ones I put there in this example are not the right ones. These are just an example. You know, different companies have different needs and different issues and different strategies. So we need to work out what the measurements are. So don't think these are, I'm saying that these are the right measurements. But we've got to measure the right things. A few key measurements, they've got to be linked directly to your strategy, and they've got to have the ability to show you where the waste is. And these are measurements at the value stream level. Now, we have measurements at the sales and processes and department level, but here we're looking at the value stream as a whole. Then the bottom here, we've got the financial information. So this is a summary of the income statement for the company, for the value stream, I'm sorry. We do income statements at the value stream level, and these are the financial results. So it's timely information that's readily understood, and the purpose is to control the costs and reduce the costs and to increase revenues and increase profits. Now, the piece in the middle is all to do with capacity. So we want to say how much of our people's time is spent doing things that are productive. How much of our people's time is spent doing things that are non-productive? And what's the available capacity that we can use to serve the customer and grow business? Now, if you look here, 62% of their time is spent doing things that are productive. If it's in a factory, there's 62% of their time is spent physically making the product. 32% of their time is doing a whole lot of other things that that have to be done. But they're not things that are productive and creating value for the customer. And then we've got 6% of available time left over, which is really not a lot in most organizations. So that's a box score. Now, how can we use this? Well, one of the uses of the box score is just reporting performance. So you can see here, we've got our 3 categories here, and then we've got a quarter across. I think that's 13 weeks there, and we've got a quarter of the month, and this is then showing what's our operational results this week. How well have we used the capacity that we've got, and what kind of financial results are we getting? And you can see here that we should be making 20 at the bottom left-hand side. Can I point there? Yes, there it is. Bottom left-hand side, our goal is to make 28% return. So our revenues minus our value stream costs. And in the first few weeks here, we didn't achieve that. Well, we did on the 4th week, and now we're doing a lot better as we go into here. Over here, we've got a goal. So these are the numbers that we plan to achieve as a result of the lean improvements and KAIZEN events and things that we're doing over this time. And also, we might be introducing new products, and there are other issues that might be taking account of. But that's the goal that we're achieving, that we're focusing on, and then this is how we would report it. This is probably the least important aspect of a box score, but people can find this very helpful. Let's look at another use. This is a box score when you're doing value stream mapping. So at the top here, we've got a current state map. Down here, we've got a future state map. And the future state map, in this case, looks out 6 months of improvement Kaizens and other things that you're doing to improve the operation. Now, how do we know what the impact's going to be of these improvements? And how do we know we're doing the best things with the, if we can do 6 Kaizen events, maybe it's 1 a month. Well, we want to max it. That's a lot of work, isn't it? A lot of planning up front, a lot of actually team of 12 people working together for a week to make that happen, and then a lot of follow-up work afterwards. We've got to make sure that we're spending that time in the very best way. So how are we going to measure this? Well, we're going to do it with a box score. So here's the same box score that we showed you before. Here's the current state information. And then we're going to look and say, well, over the Kaizen events that we're going to do in the next 6 months, what do we expect those changes to make? So we've done our analysis, we've worked out what these Kaizen events are going to achieve for us, and these are the changes, and then here is what the future state is going to look like. Now, if you look at this future state, productivity is going to stay the same. Why is that? Because we're going to have the same sales and the same people working in the value streams at this point. But on-time shipment's going to greatly improve. We're going to significant reduction in inventory days. And so inventory days is a measure of flow, one of the measures of flow. So that means our flow is greatly improving. Our quality, our first pass quality is greatly improving, and our average cost is going to go down a little bit. So these are good operational improvements. If we jump down to the financials, well, the financials are going to get better. Our revenues are going to stay the same, but our profit's going to go from 242 up to 267. Now that's good. You know, we're going to go from 17% return up to 19%, but we've got to get to 28 here. And so what we've got here is good operational improvement, but something that's a bit wimpy from the point of view of the financials. So what's really happened here? Our operationals have got better, and we've made a little bit more money. Maybe we saved some, well, yeah, we saved some costs here, but what's really happened is we've opened up capacity. Now, like I said before, it's a good question to say, what will we save when we do this Kaizen event? A better question, though, is what are we going to do with this capacity that we're freeing up that's going to make us tons of money? Now, we've got some examples here. You know, if you do this, you've probably got 16 or 20 different scenarios you could do, but I just showed 3 here because they fit on the slide. But one is we can move people out, couldn't we? We've probably got, if we've got 20% more capacity, maybe we don't need that much available capacity, so we can move some people out. We move some people out, then the operational numbers will stay pretty much the same. You can see there's a little bit of change. But this is going to significantly increase the amount of profit. Instead of going to 267, we're going to go to 285, so that's another $20,000. Still, not wonderful improvement, but it's better. The one that really happened, this is based on a real company, although I rejigged the numbers a bit to make it a bit more straightforward, but they'd done a lot of voice of the customer work previously, and they were at the point of introducing a range of new products that are not only higher prices because they create more value, but actually lower cost to make and store and introduce and market and so on. So here then, we're going to introduce new products at higher prices, and you can see that's giving a great improvement to the top line, going from 1.4 million a month to 1.7. That's a significant improvement. But look at the profit here. That's going to go from 285 up to 489, and that's going to in fact meet or actually exceed the hurdle rate goal over here of 28%. So that clearly is the right thing to do. But if you don't have that in your company, something as dramatic as that, what else could you do? Well, we could in-source products that are currently outsourced, and that would give us a much better result as well. So, and in your company, you can do a whole lot of different things that you can do, and some of them would be mixing and matching on these issues, introduce new products and in-source things. But you see how the box score works there? Now, the issue here is this number down the bottom here, this is the actual money that you're going to make based on making these changes. Now, of course, they're estimates based on what's going to happen in the future, but there's no witchcraft here like a standard cost where you've got overhead. You know, standard cost, the material cost is real, isn't it? But the labor cost and the overhead cost, these are just sort of numbers that have been assigned, usually as part of the budgeting many months ago. And that's, of course, why you have all those variances, don't you? Even material cost variance or material usage variance, labor cost variance and labor usage variance, overhead absorption variance, and all those things. But here, the numbers at the bottom here are really what's going to go into the bank. And anybody can understand that. Okay, let's look at another example here. Your value stream currently has an average price. You make about 400 products in this value stream, and the average price is $22.53. average cost is $17.92 per unit. So if you take the total cost and divide by the number of units that you sell, that would be the average cost. And that gives you a profit of $4.61 a unit. Now, a large company in your industry's turned up and they say that they want to distribute your products. They're a distributor. They want to distribute your products in a huge new market that you currently don't address. And they reckon that they can sell 14,000 units a month at a price of $15. Now, you might notice that $15 is less than the average cost of a product. So should we take this business? Now, this 14,000 represents a 20% increase in demand. Well, if we look at this, here's our box score. Here's what's going to happen if we add those 14,000. And this is what the box score would look like if we can sell those 14,000 at the $15 price. Now, look, they need to work a little bit more overtime to get some capacity, but they don't have to hire any more people, and they can increase their output to buy this 14,000 units, and that's going to give them a good result. So you can see here, if they do that, then their profit's going to go from 322 up to 384, going from 20% up to 22%. So that's a good thing to do. Even though, now, this is a good thing to do operationally and financially. Now, there may be all kinds of other business issues that you need to take into account, but the box score will show you the real numbers so that you can then address those business issues, which probably are more to do with wisdom and understanding than they are to do with the firm numbers. But the firm numbers on the box score will tell you exactly the right information. Won't make the decision for you, but it'll give you the information you need. Well, when they looked at that, they said, wow, you mean at $15 we can make a much more profit? What if we reduce the cost even more? So now they didn't really do this. I made this piece up. But now here's a what if. You know, what if the price goes to $12 instead of $15, and we can now get double the sales? We can get $28,000 a month instead of 14,000 a month more. Well, if you look at this, that's going to do us a lot of harm. You know, we don't have the capacity to do this. We've got to hire a bunch of people. We've got to get more machines. We won't have to do the overtime, and also the material costs will go down a bit because we're buying a great deal more. But this is going to be bad for us operationally and financially. So we shouldn't do that. Now, the engineers now are saying, wait a minute, this 28,000 a month, that would actually increase their sales by 40%. Why don't we create a brand new value stream that's going to work this operation? And so we can look at that another way. We can say, well, look, if we purchase automated machines, if we can make an automated process for these 28,000 units, can we make more money? And the answer there is yes. If you look at those numbers here, both operationally and financially, they're going to be much better off. So these are just examples, but can you see how you can make a decision of that sort with this kind of operation? And we're not looking at a standard cost. We're not looking at the individual products. We're looking at the value stream as a whole. And it's the value stream as a whole that enables you to give real bottom line in the bank numbers. So let's look at introducing another product. We're going to introduce a new product. So here we've got current state. We know what's going to happen when we introduce the new product, and then this is what the result is going to be. You can see, though, that they haven't got enough capacity here, have they? They can get these excellent financial results, but they haven't got the capacity to do it. So what are we going to do then? We've got to add people. We've got to add machines. So we can work out then what would be the cost of hiring the new people, what would be the cost of getting those machines, and then we can see what will be the impact of doing that. And sure enough, that's going to increase the return on revenue up to 28%. and we're going to be making a good deal more money than we currently are. So that's a simpler one. What about this, though? This is a bit more complicated. We've got 4 potential products that we can introduce into our value stream. But if we do all 4, what's going to happen here? Well, if you look here, if we do all 4, we've got an available capacity of negative 97%. So what's our choice here? Well, we can go out and we can buy a whole lot more capacity, but that's not what this company wanted to do. This company is saying we've freed up capacity as a result of what we're doing with Lean, and we want to use that capacity to make and sell more products. So what have we got going on here? Well, we've got some elementary risk analysis that's going to come in here, and we set up a box score spreadsheet that enables us to add in or take away each of these 4 and see which combination of these products would give us the best result. Now, if we had more time, I would go through and show you different scenarios here. But if we look at this, if we remove this one product, if we take this product away, then that's going to leave us then with 3% available capacity, which is not very much, but it's enough. But 3% available capacity, and we can then introduce 3 of these products, but not this one. And if you do that, then our profitability here is going to go from, what, 322 up to 1.2 million. Now, of course, there's a whole lot of work and effort and time it's going to take to do this, but the box score will show us then how we can make that kind of rather complex decision. I think this is the last one, but if we're doing a box score for a continuous improvement event or a KAIZEN event or whatever terminology you use. So here, this actually is a hospital example. So here again, we've got performance measurements here. We've got an understanding of the capacity usage, and then here we've got a summary of the financials that tells us what's going to happen to the value stream from a financial point of view. Now, if you look at that current state, the value stream is actually making a loss here and way away from its 20% hurdle rate here. Now, we're going to do one KAIZEN event that's going to have a significant improvement, and based on all the planning that we've done and the analysis, this is what we think we're going to be able to achieve. So we're going to be able to achieve this amount of operational improvement and this amount of financial improvement. When we actually do the KAIZEN, then we do the same numbers and come out with something, because we know more now, we've done the KAIZEN, this is what we think is going to be achieved. Now then, a month later, we can go back and we can review it and we can achieve more. So those are the ways that you can use the box score for decision making. Now, lean accounting also frees up people's time. You know, if we're growing the bit, and what we're going to use the time for, growing the business and improving the processes, and typically 30 to 50% of the accountant's time, you know, 10 to 25% of the operational people. And we make decisions at a lower level, so we get better results. These are the kinds of other things that we're looking for here. And it's never a one-time gain. You know, lean companies use lean accounting continually, year after year, eliminating waste, freeing up capacity, and growing the business. And this leads to unprecedented financial gains. Okay, so let's look at some of the key tools of lean accounting. There's a lot more than these ones, but these are some of the key ones that I want to address in the next 10 or 15 minutes here. Okay, so this is the way lean accounting works. We've got to understand the value stream. We have to understand the financial numbers. We have to understand the operational numbers. We have to understand the capacity we're using. We put this together into a box score, and then we can do the kinds of decisions that we're talking about, and understanding the lean improvement. And then we also, though, want to significantly eliminate the transactions and simplify the processes and take away a lot of wasted time. So let's look at performance measurements. You know, for smaller companies, we have 3 levels of performance measurements. Corporate level, typically monthly, value stream measurements, typically weekly, and then sell and process measurements that are done hourly or 2 hourly or half hourly within the production operation. Now also there are processes like sales processes and accounting processes and purchasing processes. We would have measurements on those also, and they would fit into this same approach. Now if you look at the top here, the corporate measurements are primarily for the executive and leaders to say, is our strategy working? The value stream measurements are primarily for saying, what do we have to do to improve the value stream? The sell and process measurements, they are there to control the business. We want to have measurements that's why we do it every hour, isn't it? So that we can control the business in a very detailed way. Now that also leads to improvement. So what kind of measurements would we have at a cell level? Many of you will have something like this. This is so we've got a board that where every hour, you probably can't see it in detail there, but this is the quantity we're going to make that hour. How many did we actually make? So we're updating this on an hourly basis. We're going to control the business, but also understand what the problems are, because when there's a problem, we're going to document that, and that documentation will turn into improvement projects. We are also going to have managers and support people right there on the shop floor or in the design office or in the place where you're doing your work. And the purpose here is to serve the customer today. So if we've, if we should have made 10 and we only made 6, how are we going to catch up those 4? But we're also going to be empowering the team members to understand what's going on, make improvements, and do a lot of this, just do it. Lots of visual management. We're also looking at quality and cost and some other things and safety, but this is the way that we want to look at this. So day by the hour, that's people use different terminology, but that's what I'm talking about. What's the tact time? How many should we make in an hour? And can we achieve that? If we can't achieve it, what do we have to do to catch up? And also, what do we have to do to solve that problem so it never happens again? Another measurement that's very standard is some kind of quality measure. Can we make this right first time? Can we do perfect quality here? And we focus then on standardized work, isn't it? Because standardized work is what one of the principal things that creates quality. Now there are some others, WIP to SWIP, that's work in process and standard work in process. How much inventory do we have in the cells? Operational equipment effectiveness is like day by the hour and first time through, but that's for machines. And then we've got other things like safety and 5S and things like that. So these are the detailed measurements used hourly or more frequently or less frequently, but used hourly so as to control the process. What does this do? It enables us to control it, identify the problems, and then make small, just do it kind of improvements. But that same information would be used for some of the continuous improvements that come at a later stage. And this applies everywhere. Customer service, purchasing, engineering, finance and accounting. Everybody needs a measurement board for their value stream so that they can control it, identify issues, and then make improvements. At a value stream level, now we're looking at the bigger picture. So now we're looking at weekly, typically, driving continuous improvement. So we have to have measurements for the value stream as a whole, but we also then have to have Pareto charts or something like that. These are the measurements here, and then below that are the Pareto charts, which tell us the reasons why we're getting those results. Now, measurements are good, Pareto charts are good, but they actually don't do anything on their own. What we have to then do is initiate improvement projects. These are, on this example, these are A3 documents. So we know what our measurements are, we know the reasons for it, and then these are the projects that we're using to solve those problems and drive the business forward. Again, this is empowerment of the value stream team and visual management. So that's what we're looking for in terms of measurements. Now, I've put it here, and when you get the handout notes, these are an example of what those measurements might be. But again, you've got to develop these measurements yourselves based on your own needs. And again, this is ongoing. We've got to identify the measures, what are the causes, and then improvements. And again, this applies everywhere in the organization, not just in the factory. Right? Lean's not about the factory, is it? It's about the company as a whole and becoming a lean operation throughout the organization. So that's a very brief look at performance measurements. Let's look at the accounting. Now, the first is value streams. We do all of our accounting by value stream. And what is a value stream? It's everything we need to do to create value for the customer, organized at a team level for improving the flow and growing the business. Now, in most manufacturing companies, you have two kinds. Order fulfillment that starts with a sales process, then goes through all the steps to ship it to the customer and collect the cash. That's an fulfillment of a customer's order. Another very different kind of value stream is developing new products. But we want to organize ourselves around the value streams rather than departmental organizations. Now, once we've got that, once we know what the value stream is, then we just want to say, what did we spend? What did we spend on labor? What did we spend on machines? How much material did we buy this week? What outside processes did we have this week, and what was their cost? How much is the cost of the building that we're in? You know, maybe we got 4 value streams, and one of the value streams takes up 20% of the building. Well, we would assign that cost to the value stream, and then all the other costs that come from that. Now, again, you can decide what the frequency is on this, but typically it's weekly for manufacturing companies anyway. And it's the real costs that are in the value stream. It's direct, pretty much no allocations. Now, you know, life's not quite as simple as that, but we don't want to allocate costs into a value stream, because when you allocate, all you do is create confusion. So this is a traditional financial statement. And you can see there you've got revenues at the top, cost of goods sold, and then you've got all these variances and things. And, you know, I'm running out of time here, so I won't spend a lot of time on this, but very few people in your organization understand this. But I doubt many people could actually even define what cost of goods sold. Well, you could define it, but what does cost of goods sold mean? What does gross profit mean? I think a lot of these things are actually meaningless. And then we've got all these variances and absorption and all this. What we want is what we would call plain English. What did we sell? That's what's at the top here. What did we spend? And how much money goes in the bank here? Now, we might need to know other things like what's our inventory levels and stuff like that. But down here, then, we've got, this is the profit that we're making. And you'll see, I jump back, it's the same as the traditional statement. This is a real one. So there we've got revenues, what they call variable costs, so that's the material they buy and commissions, and then they've got all of the costs that they have, in this case, for a month. This is a monthly one. This is a weekly one from another company. It's a bit of an eye test, but you can see week by week those same kind of information. What's the purpose of a value stream income statement? For the value stream manager to control their revenues, costs, and profits. It's to bring the value streams under control and then improve them. And it's to have a weekly meeting where you can review what's happening and take action. It's very action-oriented here. Eliminating waste. Well, we want to do regular lean in the accounting processes so that we can eliminate a whole ton of waste in those processes. You get a better process, but people learn what lean's about, and you free up people's time. But then we want to get into these transaction-based systems that are used to control the process. And traditional companies have MRP or ERP systems that are wasteful, expensive, and confusing, but they're there for a really important job, which is to control the process. In lean, though, we want to control the process operationally, and there's lots of things about lean that make that doable. So we want to eliminate the need for these transactions so that we can then eliminate a whole bunch of waste. Where would we look? Typically, we'd look at work orders first. We look at purchase orders and payables. We look at inventory tracking. We look at cost accounting. What are the things that we can really do that would eliminate huge amounts of waste there? And the caution here is don't automate the waste, because it's still waste. Lots of companies, in my experience, will think they've eliminated something when all they've done is automated it. And there's a terminology for that, which is perfuming the pig. Okay, I think I'm going to have to wrap up here because I've run out of time a little bit here. But this just goes through and shows, this will be in your handouts, goes through and shows how you implement both standard basic lean accounting and then on to the more significant things after that. So what are we after? Simpler systems, good information, better decisions, better financial results, make more money, less work, and true lean improvement. We focus on lean, we grow the business, we increase revenues, we reduce the costs, and lots of profits come out of that. Now, in the handouts, I've shown some little videos that you can click on, and here we've also shown some of the 3 books that we've got available, and we've got a bunch of others available on our website. So, thank you very much for attending this webinar. I hope you found it useful. If we've got time, we'll do some questions here. So over to you, Jerry.
Okay, thank you, Brian, for a very informative presentation. And we are currently running short on time. So anyone who has submitted questions, or if you submit questions now, I'll be sure to reach out to Brian to get a response and then email them to you. So if you have any questions, please do submit them, and we will forward you those answers. And this brings our webinar to a close. And our next webinar will be on Friday, August 14th, titled Kata for Daily Improvement with Drew Locker. Please visit AME.org under the AME Events and Training tab for more information and to register. And don't forget to fill out the short survey that will be in your inbox. Thank you, everyone, for attending, and have a productive day.